In today's lender review video, we'll be covering a mortgage lender that can help potential home buyers who are looking to buy through the shared ownership scheme. So, if you have no deposit and you have some bad credit, then this is absolutely a video that you're going to want to watch. But first of all, if you don't know who I am, my name's Josh Tomlinson. I'm the managing director of My Mortgage Finder. We are a bad credit mortgage brokerage. We have a team of over 30 people and we help people arrange about £100 worth of bad credit mortgages every single year. So with that being said, let's go ahead and take a look at West One's 0% deposit shared ownership mortgage range. But first of all, like we normally do with the lender review videos, is we're going to ask ChatGPT who West One are. So West One is a UK specialist mortgage lender focused on property finance, mortgages bridging, development, buy-to-let, etc. They cater to borrowers or property cases that may not fit the strict criteria of mainstream high street lenders. For instance, those with credit issues, irregular income, or complex property types. So yeah, I would absolutely agree with that. We use West One mortgages quite frequently here at My Mortgage Finder. They definitely help in a lot of cases where people have had bad credit, and obviously like the shared ownership scheme that we're going to discuss now, that can be a more complex mortgage type, so they do cater for these types of things as well. Now, if you don't know what a shared ownership property scheme is, let me very quickly explain. You will usually find this on new build properties, although it doesn't have to be. Most of the time you will see it advertised on new build properties only. And this is basically where you will own part of the property and then you will rent the other part of the property. So for the ease of math, let's just say you're buying a home and it's £100,000. You might be able to buy a share of that property, and that share would be represented as a percentage. So for example, let's say you could buy 25% of that property, you would be buying a 25% share. So 25% of a £100,000 property would be £25,000. So you're basically buying a share of that property worth £25,000. Now, there's still 75% of that property that you don't own, £75,000 worth of the property. So you would basically get a mortgage for the share that you are buying, and then you would rent the remainder. And that's ultimately what shared ownership is. You own part of the property, a percentage. Sometimes you put a deposit down on that percentage and raise a mortgage for the rest. And then you rent the remainder from the housing association, who you are basically buying and renting the shared ownership from. And you will pay rent on the remainder of that property. Now, before I go in and show you what the product options look like with West One and shared ownership, let's just take a second to discuss what a big deal getting a bad credit mortgage with 0% deposit is. Normally, you will find options available for people with bad credit, and the minimum deposit they can put down in most cases would be about 5%, but the norm would be more considered 10 to 15%. So to potentially have an option here for people who have had bad credit to actually get on the property ladder with no deposit, I think it's absolutely huge. Okay, so what I've gone and done is I've pulled some criteria and I've pulled some of the lending policy from West One's website, so we can just understand exactly what you will need to qualify for one of these mortgages. So let's start with the adverse credit, which basically means bad credit here, okay? So at the top, we've got satisfied defaults. What they're basically saying here is you're not allowed any defaults with a balance of over £500 in the last 12 months. So, for example, if you've had one in the last 12 months, but it's £200 or £300 or £400, that's fine. But if it's actually gone over £500, that's going to be a problem. And that was for satisfied defaults, just to be clear, okay? And the same applies exactly for unsatisfied defaults. The same below, 0 for balances over £500 in the last 12 months. Then below that, we've got county court judgments. That the abbreviation here is CCJs. So that's county court judgments. Exactly the same here. You've got anything over £500 in the last 12 months isn't allowed. If it's under that figure, that should be okay. and that's for both satisfied and unsatisfied CCJs. And just to be clear, when we're saying satisfied and unsatisfied, satisfied just means that you've paid it back. Unsatisfied means that you haven't paid it back. Then the next one here, it's given us a max total for county court judgments. Basically, it's saying if the total accumulation of county court judgments is under £7,500, that's just full stop. It should be okay. But if it's anything more than that, it's not saying it's not possible, but it's just saying it will be done on a referral basis. And when we say a referral basis, somebody will have to take a manual look at that and make a decision on it to say, yes, we're either happy with it or no, we're not happy with it. And the next thing we're going to cover is secured arrears. When we're talking about secured arrears, secured strictly means mortgages and loans that are attached to a property. So basically another mortgage. It's saying you're not allowed any arrears, which is basically missed or late payments, within the last 12 months, and they must be up to date. Unsecured arrears, they are accepted as long as they're up to date. And unsecured arrears, again, just to be clear, what do we mean by this? This is for things like credit cards, personal loans, maybe a mobile phone contract, a store card, that type of thing. As long as it's not secured on a property, that's generally speaking what we're referring to when we're talking about unsecured arrears. Okay, so the next one we're going to talk about is payday loans here. So basically what this is saying is you're not allowed to have taken any payday loans out within the last 12 months. So the next one is discharged DMPs, which means debt management plans. And it's basically saying if you've been in a debt management plan within the last 72 months, you're just not going to qualify for this. Next one is current debt management plans. Well, you can probably guess they're not going to allow you to be one in the last 72 months. So if you're currently in one, they're just not going to accept it. And then bankruptcies and IVAs, which is an individual voluntary arrangement, exactly the same as DMPs, debt management plans. You're not allowed to have had that happen to you within the last 72 months. A couple of other things to mention here. It does say an explanation to adverse credit is going to be required in all cases. And basically all that's saying is they do want to know why certain events happened. So for example, if you maybe just ran up a load of debt with the intention of never paying it back and you said that was the reason that you did it, that wouldn't be looked too favourably upon and they probably wouldn't do the mortgage. But if there was what would be deemed as understandable reasons why things may have happened, perhaps a divorce, a illness, or maybe a loss of a job that led to certain things happening, that would be looked upon more favourably. Okay, so let's go ahead and look at some of the mortgage rates now that West One mortgages offer. And you can see on the screen here, what they've put is a 90% loan to value, a 95% loan to value, and a 100% loan to value. And actually you'll see it abbreviated here as LSV. And you probably heard me say loan to value. What that stands for is loan share value. And by the share, it's the share of the property that you're actually buying. So we use the example, if you were buying 25% of the home and the property was worth £100,000, then obviously the share you're buying is worth £25,000. And it's basically saying how much deposit are you putting down on that share specifically. So for example, if you're putting down a 10% deposit on a share of 25,000, that would be 2,500. So if we have a look with that in mind then at the sort of loan share value and the different rates that they will offer, you've got a 90% range, you've got a 95% range, and then you've of course got the 100% range that we're discussing now. And you'll see the 100% share range, it is more expensive than if you were to put a deposit down, but that's understandable because ultimately that is more risk to the lender. And then they do have various different options. They have a 2-year fixed option, they have a 5-year fixed option, they have an option with a product fee on. You'll see there's a product fee of 1495. A product fee is a fee that certain mortgage lenders charge for taking out the mortgage. And they also have an option without a product fee on, but again, you'll see the one without the product fee, the interest rate is higher. Ultimately, if you need to understand which is going to be the cheapest option for you, that's something that a mortgage advisor will be able to work out for you. It really depends on how long you're taking the mortgage over and ultimately how much money that you are borrowing. One other thing that you'll see here as well is there is something noted down here is one of the products comes with a valuation fee refund. There is a valuation fee to be paid with West One. It depends on what the value of the property is. With a certain product, you will get that valuation fee refunded to you upon completion of the mortgage. Okay, so in terms of the rates that you can see here, you'll see that the 2-year fixed rate start at 2.74%, and then you'll see that they go up to 7.49%, and then the 5-year fixed rate start at 6.59%, and that they go up to 6.94%. And again, you'll just see that it's a little bit cheaper to go with a 5-year fixed rate, and then naturally, and by cheaper, I just mean the interest rate is lower, just to be clear. The interest rate is lower on a 5-year fixed rate than a 2-year fixed rate. And obviously, if you do pick the option without the product fee on, then the interest rate will be higher. If you pick the option with the product fee on, then the interest rate will be lower. So there you have it, West One's 100% mortgage option for shared ownership properties. Like always, I do say clearly this isn't going to be the right option for everybody, and there will be multiple other factors that come into the decision-making process and the lending requirements when a mortgage underwriter actually looks at the case, such as your employment status, how much debt that you have, do you have the eligibility to work in the United Kingdom, for example. But here are some of the key things that will be looked at, particularly around adverse credit, that we've covered off today. So, like always, if you do have any questions, please feel free to pop those in the comments below. Alternatively, you can send us an email, and the email is in the description. But thanks for watching. Please make sure you hit the subscribe button for more tips on bad credit and all things bad credit mortgage related, and we will see you in the next video.